Dycom Industries just beat consensus for fiscal Q2 2027. Revenue hit a record $2.01 billion, which is up 45.6% year over year.
Yeah, and adjusted EPS came in at $5.29, completely crushing the $4.72 estimate.
But the forward guidance for Q3 really disappointed the street. They're projecting revenue between $1.9 and $1.98 billion, with EPS between $4.33 and $4.79.
Right, which is exactly why the market reaction was so brutal. I mean,
Yeah.
DY shares just gapped down, sinking roughly 11% post-report.
Yeah.
So it's trading right around $311 now.
Right. So we have a record quarter triggering a double-digit sell-off. Let's pivot to the underlying segment data and see if we can explain why that happened.
Well, the clear culprit is the communications segment,
Okay.
which is their core business, right?
Yeah.
So they pulled in $1.6 billion in revenue there.
Wow, that's massive.
Yeah, up 16.7% organically. And that growth is really heavily driven by, fiber to the home and those long-haul fiber builds.
Okay, so the revenue is up. What's the problem?
The problem is the adjusted EBITDA margin. It contracted by 134 basis points.
Ooh.
Yeah, it dropped down to 13.6%.
Okay, wait, let me just translate that for a second. So basically, they're bringing in more money than ever, but the profit margins are shrinking. So it's actually costing them more to do the physical work.
Exactly. It's costing more to execute. But it is worth noting that it wasn't shrinking margins across the board.
Right, because I was looking at the building systems segment, and the data there looked, well, phenomenal.
Completely different story.
Yeah. They posted, what, $397.5 million in revenue?
Yep, with a highly robust 24.5% margin.
That's a huge difference from the communications side.
It really is. And that profitability was significantly aided by their recent acquisition of national technology integrators.
Right.
It gives them so much more leverage in that end-to-end digital infrastructure space. So they're capturing much higher margins on data center and facility work.
Which is heavily tied to this massive global AI infrastructure boom.
Yeah.
Okay, but wait. If the building systems segment is highly profitable and they're riding the AI wave, why is the overall market so spooked? Like, what's dragging this down?
Well, you have to look at management's commentary to find the root cause of that weak Q3 guidance.
Okay.
The big disclosure on the call was a $150 million deferral in wireless program revenues.
Wow, $150 million. So that chunk of work is just shifted to, what, fiscal 2028?
Yeah, officially pushed into fiscal 2028. And Wall Street.
They hate uncertainty.
Exactly. Pushing $150 million of high-margin work down the road, it just triggers an immediate repricing event.
Well, okay, here's where I have to push back a bit.
Okay, sure.
Because that sell-off still feels really severe. A deferral is essentially just a delayed paycheck, right? I mean, the scope of the programs hasn't changed. They're still sitting on a record $12.2 billion backlog.
Yeah, it's a massive backlog.
So is Wall Street just completely overreacting to short-term timing mechanics here?
I mean, I definitely validate that pushback. The work certainly hasn't vanished.
Yeah.
But management did point to several notable near-term risks. It's not just the deferred high-margin wireless work.
Okay, like what else?
Well, they're making immediate investments to scale up their workforce right now.
Ah, so hiring costs.
Yes, and alongside that, they're absorbing much higher fuel costs.
Oh, I see. So to go back to the delayed paycheck analogy,
Yeah,
it's like getting your paycheck delayed by a few months, but you still have to pay your entire crew and fill up all your work trucks today.
beautifully put. Yes. The money is coming, but the upfront costs are hitting the wallet right now.
Got it.
So the market isn't necessarily abandoning the long-term thesis. They're just repricing the immediate forward expectations.
Because those expansion costs are hitting the bottom line today.
Exactly. But there is a silver lining here if you're willing to look past the current quarter.
Right. They authorized a buyback.
Yes, Dycom authorized a brand new $150 million share repurchase program,
Okay.
and that runs through February 2028. And on top of that, they actually raised their full-year fiscal 27 revenue guidance.
Oh, wow.
To what range?
To a range of $7.48 to $7.66 billion.
See, that is a huge signal.
Yeah.
A buyback and raised guidance show management is highly confident in their capital position,
Totally.
even with this immediate quarter-to-quarter margin hiccup.
Right.
Well, before we wrap, a quick nudge for our listeners. If you want daily earnings coverage like this, make sure to follow the show.
Yeah. And just to connect all this back to the bigger picture, I have one final thought to leave you with.
Let's hear it.
We spend so much time obsessing over the chip makers and the software developers driving the AI revolution.
Sure, constantly.
But with Dycom sitting on a $12.2 billion backlog, heavily fueled by data center interconnectivity,
Yeah.
specialty contractors like them might actually be the ultimate bottleneck.
Oh, that's interesting.
Right. When it comes down to it, the teams laying the physical fiber might be the most accurate timeline indicator for the execution of the broader global AI infrastructure boom.
Because without the physical cables, none of the rest of it works.